This series of the 2025 50 Faces podcast is supported by Eagle Point Credit Management. Eagle Point Credit Management is a specialist investment manager principally focused on income-oriented credit investments in niche and inefficient markets. Currently, they believe that Eagle Point is the largest investor in CLO equity in the world and one of the largest non-bank lenders focusing on providing financing solutions to credit funds. Eagle Point Credit Management currently has $12 billion in assets under management. This series is supported by Benefit Street Partners. Benefit Street Partners is a leading global alternative credit asset manager offering clients investment solutions across a broad range of complementary credit strategies, including direct lending, special situations, structured credit, high-yield bonds, leveraged loans, and commercial real estate debt and equity. As of December 31st, 2024, BSP Alcentra had $77 billion of assets under management.
I do not believe that cultures create themselves on their own. They require work. It's sort of no different than kind of tending to a crop. If you're going to have it grow and flourish and be successful, you have to work on it. And cultures can't be static. A culture that works for 26 people doesn't work for 126 people and doesn't work for 1,026 people.
I'm Aoife Devitt, and welcome to the 50 Faces podcast, a podcast committed to revealing the richness and diversity of the world of investment by focusing on its people and their stories. I'm joined today by Erik Hirsch, who's co-chief executive officer and board member at Hamilton Lane, where he is responsible for the firm's strategic direction and operations. He's also a board member of Novata, a public benefit corporation that collects, analyzes, and benchmarks relevant ESG data on behalf of private companies. He's vice chairman and trustee of the University of Virginia's College Foundation and serves on the board of the Philadelphia 76ers Youth Foundation. Welcome, Erik. Thanks for joining me today.
I'm thrilled to be here, and it's nice to be with you again.
Well, I have got to know you, I feel, quite well through the sometimes humorous Hamilton Lane videos that come out every year. But I'd love to dig in a little bit more into your own background and the path to Hamilton Lane. So maybe if you could start there with where you grew up, what you studied, and how investing and finance made itself known to you.
Well, the answer to the last part of that question is sheer dumb luck. I grew up mostly bouncing between sort of the Pennsylvania area and North Carolina. I went to the University of Virginia, where I was hell-bent on becoming a lawyer, and so was a government and philosophy major. So clearly was not thinking about either finance or anything that would require a certain skill set. And at some point along the way, I sort of decided I really don't want to be in school anymore. I don't want to be a lawyer. And so I got very fortunate and landed with a public finance company here in Philadelphia that had a spectacular training program. And so was able to take the government and philosophy kid and actually give them a real finance skill set.
Well, that is not as unusual a path into finance, I think, as it used to be. There's lots of precedent now of firms seeking out liberal arts backgrounds as well, although the government piece probably quite relevant. Just before moving into how that job ended up in the Hamilton Lane role, philosophy, studying philosophy. Do you think that shaped you in terms of maybe your approach to the workplace, approach to roles, anything that you take from that?
My takeaway from that major was really just learning to think and to think critically. If you had asked me to think back on specific cases that we studied, I would struggle at this point, given my advancing age. But I think the sort of critical thinker part and just being willing to examine a problem from different perspectives, that was really for me the big takeaway. And when you sort of blended that with the government political science piece, the ability to communicate, the ability to kind of express an idea, those parts are essential to being successful in finance. I think we sometimes get overly caught up in the nuts and bolts and the real mechanics of, can you build this model and can you do that? And I think once you sort of get into the industry, what you realize is that parts of those skill sets are more commodity oriented. And it's really that critical thinking, particularly the ability to examine a problem from multiple perspectives.
Right, as well as the classic question, why are we here? What are we here to achieve?
Always a good one to be debating.
Exactly. In terms of then the career path to Hamilton Lane, can you talk us through that? Were there any surprises in there?
So several surprises. So I came out of college, as I said, I joined a public finance firm that was called Public Financial Management. And there we were basically providing services to governments, helping them with bond issuances, strategic consulting projects. And so I spent about 3 or 4 years there working with the various municipalities and trying to help them solve critical finance problems, budget issues, or in some cases, building new infrastructure like stadiums or bridges. And then I moved into a very traditional corporate finance role where I just entered an investment bank and became kind of employee number 3 in sort of a fledgling office of a much larger bank, trying to build an M&A practice. And so that was taking a lot of those public finance skills, which are very, very technical, heavy Excel oriented, into more of that corporate finance and corporate accounting world. And that sort of opened my eyes up to the fact that private equity existed. Before moving into that industry, I had never really heard of private equity. It wasn't something that was at all on my radar screen. Again, it didn't come up in college as a philosophy major, and it wasn't something that the public finance people spoke about at all. And so it wasn't until that move to corporate finance with an investment bank where all of a sudden I saw this whole other kind of adjacent industry that existed. And then I was fortunate after a stint at that investment bank that Hamilton Lane kind of came knocking on my door via a headhunter.
And fast forwarding now to your obviously extremely senior role as co-chief executive officer, what's on the forefront of your mind today? Maybe you can even, kind of stepping back, we can look at the landscape, because the firm itself has evolved since I first got to know it. I got to know it more as a consulting type of a firm, and now it clearly is much more multidimensional than that.
So the firm's been around since the early 90s. And as you said, its first iteration was as a consulting firm. It was really identifying the reality that as the alternative markets were going to become something that institutional investors began to participate in, that they were likely going to need some help. And if you think back to kind of the late 80s, early 90s, there were a handful of fund-to-funds firms that existed, but that was a very particular solution, which was, hey, give us your money and we'll deal with it for you. And our founders were thinking about the fact that there might be some people who want a more collaborative approach to that. And so we began consulting to pensions, insurance companies, endowments to try to help them build their programs. And while we still do that today, as you note, the business has continued to grow and mature. And today we would identify really as an asset management firm where we're providing products and solutions to investors. But I think what hasn't changed is that client DNA, the desire to collaborate, to sort of talk through problems together. And I think that has been one of the real hallmarks of the firm's success, is that it's not sort of this arm's length kind of keep the customer away from you. It's actually welcoming the customer's involvement, welcoming input, and having more smart people around the table sort of thinking through things. So when I got here, we were probably about 25 people total. And today we're nearing 800 people with offices all over the world. So it's been quite a journey.
I'm just going to get back to that topic of people, because I think I've cited the videos that I've really enjoyed, and I think they express a team spirit, a sense of humor and self-deprecation at times, not taking oneself too seriously. It's also a group of people where there's clearly a strong culture, notwithstanding the significant growth. And maybe just even starting from the top, co-CEO. That's sort of somewhat unusual structure, even co-leadership. Can you talk a little bit about the governance and then the people and the culture at Hamilton Lane today?
Well, I'm thrilled that you're sort of interpreting those videos exactly as the way that they're intended, which is, I think as an industry, I think we find a lot of folks take themselves too seriously. Maybe we sort of think of this as all, more difficult than it actually is. We like to believe it that it is. And I think one of our pillars has been that humility and trying to distill complicated things into pieces that are very digestible, and to do so with a laugh. It doesn't have to be so serious. So I think we've worked really hard on a culture. I think cultures can be a little bit amorphous. There's not a culture, or there's not a right culture. You have to find what works for your organization. But I do not believe that cultures create themselves on their own. They require work. It's sort of no different than kind of tending to a crop. If you're going to have it grow and flourish and be successful, you have to work on it. And cultures can't be static. A culture that works for 26 people doesn't work for 126 people and doesn't work for 1,026 people. You can have tenets of it that exist. And so some of our tenets are the humility. Some of our tenets are teamwork and collaboration. But you have to sort of adjust around the edges because your demographics are changing. Again, for a firm like ours, you're very global. And so you're dealing with sort of multiple dimensions around that. And so it takes focus. So now to get to the next part of your point, what's the reason for a co-CEO? I think there's a couple of reasons. So one, my partner, Juan Delgado, and I have been friends and partners for a long, long time. And while we share a lot of things in common, we have some real differences. And so Juan's focus is really on the sales and client side. So in that role, extensive travel, extensive time face-to-face with the customers. He's also headquartered in Hong Kong, whereas we noted I'm in Pennsylvania. My role is more on the strategy of the firm and the operations. And so by having a little bit of that divide and conquer and the geographic diversification really allows us to kind of be present in different ways for different purposes. And what we have found is that that is a really powerful combination.
And then in terms of the asset base itself, I'm really intrigued by this because clearly you spend a lot of time working with clients and responding to their evolving needs. And, we talked about the evolution of the industry, of which Hamilton Lane was a part. How would you say what are they demanding today in terms of alternatives? Is it total return type portfolios where they're agnostic as to label? Are they looking for income? Are they looking for something very specific? Do they want evergreen? How would you say some of the demands fall out today?
I think this is really what's great about where we are, which is we're maturing. As an industry, we're maturing. And part of being a more mature industry is that you have more choice. And so if you think back 30, 40 years ago, clients came to alternatives thinking about, high return and therefore high risk. The industry was very associated with venture capital. And that's kind of how we were really defined of venture capital. And then we moved from an industry that was venture capital to buyouts. And today it's much more multidimensional. And I think what sort of makes it a more mature asset class and frankly, a more attractive asset class is that you can be different things for different people. So we have clients today that sort of view the private markets as a way to get yield exposure. They view private credit as more attractive than public credit. And so when they talk about the private markets, they're really talking about private credit. And we have other clients who still think about the private markets as a chance for sort of generating real alpha. So they're very focused on growth equity and venture capital. And then you have others that think about the private markets around infrastructure, real assets, and real estate. And they love sort of that development aspect and the hard asset piece. They like the long duration. And then you have people who are doing all of the above. And so not only has the asset class matured, there are way more managers, and so there's way more choices, but there's way more flavors of ice cream. I love this analogy because we started as an industry as kind of a chocolate and vanilla. It was like buyout or venture. That was really it. And today, there's a lot of flavors. It's sort of the Baskin Robbins, if you will, of 33 flavors to sort of choose from. That's a good thing. Investors like choice. Investors deserve choice. And if you can give them more choice and appropriate structures for them and their needs, that keeps them kind of coming back and growing with the asset class and growing in the asset class. That's what we're experiencing today. I still think we're pretty early in the journey. If you think about the private markets relative to the public markets, we're way less mature, way fewer vehicles, way less choice. Today in the public markets, the proliferation of ETFs is allowing you to dial your portfolio construction in very, very, very granular ways. We're not there yet, but you can see how we're evolving and where we're heading.
We're going to take a short break to hear from one of our sponsors of this series, Eagle Point Credit Management. I sat down with Tom Majewski, founder and managing partner of Eagle Point. I asked him how interest rates would affect general CLO strategies.
The impact of interest rates has been both significant and minimal all in once. Across most loans, essentially all loans and CLOs are floating rate. They used to float off of LIBOR, now they float off of SOFR. And CLO debt, by and large, floats off of SOFR as well. So your assets and liabilities, the base rate is substantially matched. But what people forget is when companies are underwritten and when the rating agencies rate companies and when banks and collateral managers underwrite loans, they're typically underwriting a company with 3 to 4 times interest coverage ratio. So in that case, where interest almost doubled, you still had a lot of margin of safety in terms of companies' ability to service their debt. And then B, many companies were able to pass on the high inflationary costs that they were facing through to their customers. Now, the flip side, if you look at commercial real estate, if you look at an office building like the one I'm standing in or the one that you may be in right now, when that loan, if that building has a mortgage, it might have been underwritten at a 1.4 times debt service coverage ratio. Very different than 3 to 4 times. But just the raw math of if you were borrowing at a rate and you only had 1.4 times coverage or 1.5 times coverage, the increase in interest rates has really hurt. So it's not been a big factor in the CLO market for the performance of CLOs. What it has made more interesting, frankly, is CLO debt. And whereas when base rates were less than 1%, the all-in returns on CLO debt weren't that exciting.
And now back to the show. And one of the areas that I've seen some development on is this idea of investor identity. And certainly the larger, say, sovereign wealth funds or very large institutions have quite complex identities, which are tied in some ways to the need to invest locally, the need to have impact. Some may or may not have sustainability at their core. How are you extending to be able to allow expression of values within portfolios besides simply the achievement of returns?
So I think it's a great question. We're doing a few things. One is, again, more choice, more vehicles, and so letting investors tailor their portfolio. Our growth as an asset manager has really been around customized separate accounts, recognizing that for a number of investors, a one-size-fits-all approach does not work for them, that you need to offer them something bespoke. And so that's been one of our hallmarks for years. When you talk about the next piece of sustainability or people focused on impact or people wanting to sort of make investment decisions and tie that to other pieces, our view there is data is really the solution. We have to be empowered with data in order to measure and assess what our organization's goals are. We don't think, again, that's a one-size-fits-all either. So even if we talk about sort of ESG and we put a bunch of investors in a room, we're going to get varying views on whether people care more about an E or the G or the S. And I think it's a real mistake to sort of assume or to presume that we should tell people what they should care about. One of the reasons why we were one of the key founders of Nevada, which is a business that collects ESG-oriented data on private companies, is because we don't think that there should be this kind of uniform scorecard. With Nevada, investors are able to access key data points from portfolio companies so that they, as the investor, can interpret those data points through whatever lens sort of governs their organization's perspective. And we think that is the sign of a maturing industry, and we think that's a much better path forward.
I'd love to dig into that a little bit more, the use of data, because that's another thing, a hallmark of Hamilton Lane, as I've seen it. I think it was a decade ago. I went to one of your annual meetings and you may have been discussing a little bit the introduction of data then. And it was definitely a departure from the sort of black box of private equity, which was deemed to be not a quantitative exercise and purely network-based and relationship-driven. And I know it's still a piece of that, but how can you use data to help you with selection and add performance in private equity?
Well, I think our industry has done itself a real disservice by taking kind of the private and private equity to an extreme. Decades of people not wanting to talk about their performance or not wanting to tell you what company they invested in. And it was really silly. It was silly then. It's even sillier now. And we're moving past that. But I think it did real harm to the industry and sort of stunted, frankly, its growth. Transparency is important. Data is really important. The other thing that I think this industry has really failed on is that we spend almost no time talking about portfolio construction. Go to any cocktail party with investors, and you're going to end up in two conversations. One, what deal did you do recently that was amazing? We don't ever seem to talk about the ones that don't work. And what fund manager have you sort of partnered with recently that you think is amazing? Again, we don't really talk about the ones that don't work. But one of the conversations that you're not going to hear at that cocktail party is portfolio construction, asset allocation, thinking about how to sort of combine those building blocks. For us, that's something that we spend a huge amount of time on. In the public markets, if we went to a cocktail party, we would spend very little time talking about a manager or an individual stock. Instead, the chatter would be a lot about where your portfolio is overweight or underweight or tilted or not. And so we think that that mindset has not existed so much in the private markets because of a lack of data and a lack of tools on how to analyze and use the data. So for us, we think at Hamilton Lane, one of our key differentiators is this data with this ability to make it into a portfolio overlay, and we have the tools to do that. So our industry is no different. Asset allocation and sector weighting is enormously important. If you decided to be light venture or heavy venture, depending on where we are in the cycle, forget which managers you picked. Sure, that's important. But if you got your asset allocation wildly wrong, it really cost you, or conversely, it really benefited you. So it's data, it's tools, and it's this sort of portfolio construction piece. Again, no different than every other asset class. We just, as the private markets, have kind of deemed ourselves sort of to be different or unique, and we've generally shied away from it. We are not shying away from it. We think people who are shying away from it are making a big mistake.
And it's interesting. I do think also breaking down some of the complexity and seeing how the national press or the financial press are getting a little bit more experienced in reporting on private assets is a very positive thing. I think we're not relying on the kind of 1980s concept of shadow banking or barbarians at the gate. I think there is a bit more nuance emerging, which is only a good thing in terms of demystifying some of that for us. And just getting back to culture, just to close out the discussion on Hamilton Lane, you mentioned before yourself not coming from a traditional STEM background, perhaps, or hard finance background. What kind of individuals tend to thrive at Hamilton Lane? Do you invite a mix of different backgrounds? And what's your 800 people look like?
Huge mix. I think diversity in every shape and form just makes for better decision making. I think there's no worse scenario than saying that at the core, which is what we are, we're a decision-making company. We don't really produce something. There's no widget manufacturer in the basement here. We're really making decisions. And I think the way you make the best decisions is that you have a mix of people from different backgrounds with different educational perspectives, with different demographics and different growing up experiences who are going to look at that problem through a very different lens. And if you get the benefit of all of those different perspectives, I think you're going to yield a much better result. So if we took the 800 Hamilton Lane people around the world, what you would see is different age brackets, different genders, different racial ethnicities, different educational backgrounds, different work experiences prior to coming to Hamilton Lane. And I think all of that is wonderful and powerful.
And tied to that, you're on a number of board roles, and boards also are charged with decision making. Anything that you have gleaned from those board roles in terms of what makes a good director or chair in those type of functions?
I think it's collaboration. I think it's, again, ability to look at problems through other people's perspectives. On the few of the boards that you've mentioned, for example, on the University of Virginia board, the only thing we have in common is that we all went to University of Virginia. Beyond that, we're in different industries, we're different ages, we're different genders, we're different racial profiles. It's a real diverse mix of people and perspectives who are all simply united by a goal of trying to help the university to be better, to advance, and to provide sort of the best experience for its students that it possibly can. So I think healthy board dynamics, because there can be very unhealthy board dynamics, but healthy board dynamics are no different than kind of healthy cultures. That being open and willing to hear other perspectives, engaging with others, playing nice in the sandbox with others, all of those things I think just go a really long way.
And given the clients you work with, some I'm sure have invested a lot of thought into their governance and what is optimal governance, whether it's a delegated model or a smaller committee or a larger committee. I mean, there are different things work for different types of entities. Have any examples of best practice that you've seen in terms of moving that decision-making success ratio along that you've, or maybe better feedback or better board training, anything that you've seen that is best practice in governance today?
I don't think there's one best practice model. I think where I've seen it, where it works, again, using different structures, is that the board understands how it makes decisions and the board understands in which environment it makes decisions. And there is kind of a North Star that sort of governs their decision making. Where you see dysfunction, regardless of the sort of technical structure you're using, is when you sort of ask people, what's the North Star? What's the mission? What's the decision tree? And you ask 5 board members and you get 5 different answers. Once that's happening, regardless of your technical structure, you know you have a messy situation. So I'm a big believer in simplicity, getting people aligned on a goal, articulating that goal, clearly defining that goal, and having everyone understand the goal. If you can kind of create that in your organization, you're going to be a better organization.
So it does get back to the philosophy and the why are we here in the North Star. I think a lot of it actually aligns when you think about mission and purpose.
Perhaps my degree was more valuable than I thought it was.
I think so. I'd just love to give some personal reflections now. Looking back over your career, would you say there were any highs and lows? And if there were lows, any particular learnings from them?
Well, I think lots of both. I can't imagine a career that doesn't, frankly, have both of those. I entered this industry quite young, So I probably joined Hamilton Lane at the age of 26 or 27. I was its chief investment officer before I was 30. I think that was less of a reflection on me or my talent level and more of a desperate times, desperate measures, small firm finding its way and trying to kind of just put pieces in place. I handled some of that well. I handled some of that poorly. You were sort of forced to kind of grow up at an awfully young age. And I think you learn a lot from that. I think, ironically, I probably cared too much. I cared about everything, and everything to me was equally important, and everything I wanted to sort of debate and argue over. And I think sort of maturing, you start to realize picking and choosing your places and not equal weighting all decisions and knowing kind of when to lean in and when not to. And frankly, also getting more comfortable in your own skin so that you trust people around you in a bigger and better way. So I've been fortunate to have some terrific role models and mentors over my career. There's been highs, there's been lows. I think that's very normal. But I think what makes successful people successful is ability to sort of be self-aware, to be introspective, and to frankly be your own critic, that you sort of get the external feedback loop, but you're also good at trying to develop your own internal feedback loop. And you get help along the way and you work hard and you try to figure it out.
It's interesting you mentioned mentors, because I think that aspect of, knowing when to lean in, when to lean out, that kind of calibrating your effort, which is needed the more senior you get. There's no textbook for that. There's no university course for that. It has to be learned kind of on the job. Were there any particular key people that were influential in shaping your career?
Several. I mean, my partner, Mario Giannini, who I've had the privilege of working with for over 20 years, has been an enormous influence on me. My first real boss out of college is still a close friend and still thinks he's my boss and still regularly mentors. And so I'm a big believer in it. I've benefited from it. I do it today still. I have several mentees that I also enjoy working with. I think it's crucial. You said it. There's no textbook. I think I spend a lot of time talking to, our younger employees, and just I like being around younger people. And I think one of the flawed thinkings is that everything I need to know or everything I need to learn, I can kind of watch a video or I can look up something online. And while that is increasingly true for a lot of skill sets, that's harder on some of the kind of the intangibles, sort of the personal dynamic pieces, the how to network and how to mingle and how to influence people and how to effectively communicate and share opinions. Those are things that, sure, you can read some things or you can watch some videos and pieces, but it doesn't replace seeing somebody who's really good at some of those actually doing it and being in the room when it happens and being aware of it, studying it, reflecting on it. And so I think all that is important. I think it's necessary. I think we're not, as a sort of a society today, doing enough of it, and we need to do more of it.
It's interesting. It reminds me of the difference between passive learning and active learning. You can't simply expect a child to learn everything from watching television. They need to actually play and experience the things. So I think they're probably the same, probably at a professional level will make a difference. My last question is around any words of wisdom. You've already left it with that nice idea of an internal feedback loop. But any other words of wisdom, creed or motto that you live by that you can leave us with here?
I think I go back to the self-awareness piece. I think when I look at people who are very, very successful, they tend to have high levels of self-awareness. And self-awareness means you're kind of aware of what's good about you and what really needs improving. And I think sort of working on that and being willing to be self-critical and self-reflective, not in a way that is damaging or sort of paralyzing, but in a way that's sort of thoughtful and constructive with a view that I can be better. And so wherever I am today, I can still be better tomorrow. And let me talk about how to do that and how to get to that path and how to make that work. I think sometimes I see young people who become self-critical to a paralyzing path, and that's damaging. And then I see people that are so non-self-aware that creates its own set of issues. So I think finding that sort of healthy balance and acknowledging that it's there and that it's important, I think is critical to success.
Well, I think that self-awareness piece, it nicely embodies what I said before Hamilton Lane shows through its videos and its interactions, its conferences. Or you could say that the firm captures the philosophy of its founders and its members. But either way, I think it is a unique contribution you're making to the industry. You're continuing to push us out of our comfort zone through the use of data and through thinking about new frontiers. So thank you so much, Erik, for coming here and sharing your insights with us.
I love the conversation. Thank you for the privilege.
I'm Aoife Devitt. Thank you for listening to the 50 Faces podcast. If you liked what you heard and would like to tune in to hear more inspiring investors and their personal journeys, please subscribe on Apple Podcasts or wherever you get your podcasts. This podcast is for informational purposes only and should not be construed as investment advice, and all views are personal and should not be attributed to the organizations and affiliations of the host or any guest.